Welcome, everyone. This is Dave from Signal Fund Services, and today we have a really exciting conversation with the team from Colibrí. They've recently released some research on emerging venture managers, and that's a huge focus for us at Signal Fund Services, working with brand new venture fund managers as they build out their back offices, think through some of the important strategic and operational designs for their firm, and help them give the best experience to their LPs. We do that as CFOs, but we help a lot of firms, and this is a topic near and dear to our heart. So I've got the team today from Colibrí, Mariela and Itzel, who will be talking to us a little bit about the research they've done, how it impacts LPs that invest in emerging managers, and how GPs of these firms should be thinking about their relationships with LPs and how they present themselves in the marketplace. So excited to have them, excited to get this conversation going. So I'll turn it over to you, Mariela, to kind of explain to us a little bit about what y'all do and what the benefit of the platform is.
Yeah. Hey, Dave, number one, thank you so much for having us today. We're really excited to be joining you and to be having this conversation. So I am Dr. Mariela Salas. I am a co-founder and managing partner at Colibrí. Colibrí is essentially a two-armed platform that my co-founder Itzel and I are building. What we're going to be focusing on today is the nonprofit research institute side. So Colibrí Institute sort of is built to address the sort of gap in information and data and voice for the emerging manager in the broader venture capital ecosystem. We work across three pillars, and the first one is our open research that speaks to venture capital and capital flows. The second pillar is centered around tech, AI, and governance policy, really making sure that the policy or that we are informing policy through the lens of the emerging manager so as to not sort of broaden the gap or broaden the burden for the emerging manager. And then the third pillar that we work in, which is a little bit smaller, is ecosystem building. And what we mean by ecosystem building is not necessarily networking and happy hours, which we absolutely love. However, we think that there's also a really important need for there to be stakeholder convenings where the folks who have a direct stake in how emerging managers are entering into the ecosystem are convening. And then I think the part that's been missing in the ecosystem for a really long time is the readout of what's actually happening in those rooms. And so that is what Colibrí Institute does.
That makes a lot of sense. I mean, the conversations I have with GPs and LPs, the business is very much relationship driven, but there's so much information that both parties don't really have. You're a GP of one firm, you're an LP investing in a couple of different firms. And so it makes a lot of sense to kind of broaden this conversation out, provide a platform to talk about, the future of venture, which that makes a lot of sense. So how do you guys go about kind of starting off these conversations now?
Yeah. So the first thing that we did is that we publicly launched Colibrí Institute in February through the launch of our first white paper. It's called Why Emerging Venture Capital Managers Matter, Rethinking Institutional Portfolio Construction. And that was led by Itzel. So I will let Itzel take a stab at giving us an overview of what those findings were.
Great. Well, first of all, Dave, it's so nice to be here. It's so nice to chat with you. These discussions are just so fun for us. We get a chance to talk to the ecosystem as well as just do an actual readout of the work that we do. But going back to the white paper and a high level, the work that we do, we launched in February. However, this research has probably been in the works for about a year or so. So it's a lot of work that went into it on the back end, but publicly we don't get a chance to see that. A lot of this research is building on my doctoral dissertation research as well. So it's very empirically validated and empirically grounded. A lot of the work that we did, however, focuses on translating those things into more actionable and tangible takeaways for both GPs and LPs. So a lot of the work that we do is translating it, make this easy to digest, and honestly, just to have conversations like these.
And when I was reading the white paper, I found myself like nodding along at a lot of the conclusions in it. Because, for some of us that spend so much time deep in venture and talking to so many managers, these themes pop up, but it was always anecdotal. I was always able to say, I knew 3 firms like this, or I knew a couple of people who did X, Y, and Z. But now we actually have some data that kind of backs up some of those themes that I think we've been sharing with, our clients and with other fund managers. So yeah, I just say thank you for doing the research. It's helpful to kind of validate some of these ideas. But part of it, I'm curious, how did you guys come to this hypothesis or this direction for the research? Why did y'all identify maybe this is something that's crucial for what's not working in the ecosystem?
Honestly, very similar to your thought process was we've been anecdotally hearing about emerging managers outperforming. A lot of the very common stories that we hear, for example, from LPs are out of our entire fund, certain GPs are just outperforming. I mean, it's the same profile that typically falls under what we consider an emerging fund manager. So we usually hear like this type of EM is doing great work. This type of EM is doing great work. So all of our research starts with the hypothesis that honestly it may or may not come true and it may or may not back up what we think. Luckily for this one, it did. So that was something just very rewarding. When we start with the hypothesis, we're like, we hear this all the time. It may be wrong, but let's try it out.
Well, so you said something interesting there, like defining the emerging manager and coming up with research for it. How did y'all start by kind of defining emerging managers? Because there's lots of definitions out there. And I feel like if you've met one emerging manager definition, you've met one definition. So how do you guys think about structurally setting up these managers as separate from more established funds?
We were actually just on a call yesterday where we were talking about all of the definitions that there are out there for emerging managers. And previous to my role, previous to launching Colibrí, I was running an organization called Somos VC. Somos VC is the largest and premier network of Latino venture capital investors in the U.S. And what we were finding, and based on the data that we had there, was that we had a lot of emerging managers. In fact, the Latino community skews a little bit higher when it comes to starting their own funds. They weren't able to unlock institutional capital. And a lot of the LPs that we were talking to were saying, well, we have a mandate to invest in diverse or underrepresented groups. However, there's this mismatch between what we qualify, how we define an emerging manager versus what an emerging manager in your community actually is. And so what we realized was that we need to actually come up with one standardized version or definition for an emerging manager. And Itzel found this wonderful work done about 10 years ago by an organization called Next Tier, where they had given us sort of a basis to work on.
Yeah, so that actually came from, like, again, my dissertation. I have an amazing committee, and it just so happens that Dr. Marlene Orozco was my committee for my dissertation, but she's also a board member for Colibrí, just to give you an idea of how important these things are for us. And one of the things that honestly she flagged was, check out this paper, let me know if it speaks to you. So she knew our work, and she kind of guided me into that direction. Once we read that paper, we're like, okay, this is what we're talking about. Someone else way smarter than us already put some thought into this. About 10 years ago, the only caveat with the Next Tier definition is that it is talking about private equity in general. And our work focuses in venture capital. So what we did was we extended that Next Tier work that was done. We extended it particularly into venture capital, and then we empirically validated it. So a lot of the cool things that we do about research is that we build on other people's work, and hopefully someone else will build around our definition and further refine it until it just gets better and better every day.
Yeah, absolutely. So in your mind, an emerging manager, it is a loose definition. It generally corresponds to a point in the firm's development. Maybe it's how much AUM, which is like a function of budget, how many vehicles they have, which is kind of a function of complexity. But there's a couple of distinguishing hallmarks for y'all that mark an emerging manager, and that kind of framework came from the prior research.
Correct. So at a high level, how we define an venture capital emerging manager comes down to definition of institutional exclusion from search processes. So this probably looks a little bit different than a lot of definitions out there. And the reason why is that the rationale is coming from a space of inclusion and exclusion for the larger LP base and how that process has been done in the past. On a more tangible level, that looks like a couple of things, just very high level. One of them is AUM, usually funds under 100 million. For VC is considered emerging. And I say for VC because for private equity, that might look like $1 billion or so. So for VC, go back, we're scaling back a bit to about 1 million. Track record is also important. So probably funds 1, 2, and 3 are also considered emerging managers. the year in which the firm was established in itself, which I think this speaks a little bit to the work that you've been seeing, is typically funds that have been in operation for about 5 years or so, their operations are probably still in the process. There's not a lot of things that are just processes based or things that are probably just done based on how we've done things in the past. Still figuring out a lot of these things. So the 5-year firm vintage is kind of an important one for operations, which I think you know a lot more about than we do. And then the last one is GP founder composition. So that typically looks like a demographic team of a woman or person of color on the GP founding team. It's also considered emerging. So that probably speaks a little bit more to definition that we've all been kind of known in terms of what diversity is. But I want to go back to the actual larger definition, which is institutional exclusion.
I like that. I think that makes a lot of sense because the goal for all VCs is not necessarily to invest in only one type of founder or company or raise money from only one type of group of LP or one geography. But most fund managers think about building kind of a diversified set and they think of it as a portfolio. And a key piece of that is one day getting institutional investors into your business and investing into your funds. And so if you're on the outside looking into that process, it can be quite daunting and you're not really sure where these lines are or when you get accepted into the group of now emerged funds. So yeah, I deal with that kind of loose definition all the time. And what we ultimately kind of remind people about is, the early days of your firm building is really about showing to LPs you do what you say you're going to do, that you actually have the access to deals that you say you're going to have, that you follow through, that you show repeatable decision-making processes. They know, it's not going to be perfect, but as they're trying to understand how your business is growing, just as VCs understand startups, like you need to see some of these milestones of progression to show that you're ultimately building a bigger platform, one that can handle more resources, but two, can make higher stakes decisions on behalf of these LPs. So yeah, that all makes sense to me in terms of how you stage the definition. Okay, so a couple of core conclusions came out of the research. And so I was curious if any of these core conclusions in your initial conversations with people were kind of like mythbusters or things people didn't expect to be true, but ultimately your core conclusion kind of moves the known group of information to a new place. Was there any of the core conclusions like that you found people were surprised by?
Our main conclusion is that emerging managers outperform established managers. For a group of us that have been in this ecosystem, that probably isn't anything new. It's probably just something that we have a quantifiable number attached to something we know anecdotally. But some of the feedback that we've received just on a high level is, well, typically emerging managers are not the safer bet. So that's a myth that we're trying to kind of address in a way that makes sense in terms of portfolio construction, and the framing behind it is, well, are they the safer bet or is that a perception? So I think the perception behind how emerging managers perform, which was our huge finding, is actually the one that I think was probably the largest one that may surprise people. But to your point, Dave, it's in certain circles. That have been in this ecosystem, this information is zero new. It's just like, oh yeah, I knew this already. Thanks for sharing. But in other circles, it might be new and different and challenging.
I often think about who the logjam is in the like we all know that emerging managers tend to have outsized returns, but we all hear LP say it's really hard to underwrite and do the diligence into smaller firms that have less known about them, right? It's just harder to do that. And so I don't know how we get the persuasion to the right people in the right organizations to unlock that, because it seems so obvious. We just need to make diligence a little bit stronger. We need to make it easier and less frictionful. And then you'd see bigger institutional investors writing smaller checks into many more firms.
We can try a lot. We can try to educate larger LPs or larger institutional LPs on what they're missing out on, like the returns they're missing out on. But ultimately, what needs to change is the investor's agency, right? Like, how are they making their decisions and how can we get them to be more convicted to actually double down on funding emerging managers? We don't know what that looks like. We're exploring that. We're hoping to get there at some point. But I think that there is a path forward. We just need to continue having very open conversations with larger LPs and maybe put together a couple of case studies, even if they are anonymized, so that they can see what those portfolios looked like and what the returns actually were. Like, is the risk actually worth the return? Is the time actually worth the return?
A lot of the work that we do and that we focus on has a little bit of an anchor of governance behind it. Like there's a lot of tangible things, for example, that the report touches on. We talk a little bit more about like how to address and how to analyze a deal using enterprise risk as opposed to AUM. Like, and I'm happy to touch a little bit more about that. But the behind that is a conversation of governance. So ultimately, to answer your question very directly, is who should be having in these conversations are probably large allocators, CIOs, decision makers, chairmans. I want to see the board. I want to see everyone involved. I think one person may want to have and is convinced and that this is an asset class worth investing. At the end of the day, this is an asset class like any other, with just a very specific profile. But the why behind it needs to have support from the rest. Because new ideas are easy to shut down.
And I think it's helpful to have a credentialed team, right? A research project, because the reality is many large allocators, they do have boards and investment committees and investment policy letters that have procedures for how they get updated. And, and all those things take time. The larger the organization and the more resources, it's very deliberative. And so it takes time. And so I think, yeah, I totally understand doing the hard, slow work of getting in front of CIOs, showing them research that they can then go to their board and stand behind this research that's empirical, as you said, and cover so many firms and so many different fund vintages that they can say, look, this is a risk worth trying, that if we want access to the alpha in venture and we can't get access to these mega platforms anymore, we need to find a new strategic way to access these types of returns. And emerging managers are the platforms that are open, considering some of the largest Sequoia and A60. Those platforms are more or less closed to new LPs. And so I do think I agree with you on the how do we need to get the CIOs and these boards on the large allocators more research to show that this is a risk worth taking, for sure.
As I've been thinking about a conversation that we had with one gentleman who is sort of one of the pioneers in the industry, he said that the best way to help change it is, number one, starting with agency, but also number two, building it into the governance.
Yeah, I mean, because my limited experience, you hear people on panels say things like they're typical obstructions to investing in smaller managers or smaller funds is one, that nobody gets fired for buying IBM. If I go with a fund 7 of a large platform that's had 3 or 4 good fund vintages, I'm less likely to catch flat from my board or from my peers or whoever I work for if that decision is poorly timed or there's a bump in the road in the journey, so to speak. So there's some like flock to safety, I think, that we have to talk through to folks. And then the other piece of it, to your point about, getting it into the governance of this. Yeah, I mean, the reality is there are just some documents that have to be updated and there's conversations and these things happen slowly, quarterly. So you have limited opportunities. But I think the more that we talk about the fact that emerging managers are a better risk return for your opportunity set compared to later stage or more established firms, we help people understand the risks and rewards. I hope that leads to like better results. I mean, it seems intuitive to me that it will.
Yeah, absolutely. And honestly, that's one of the feedback that we've received from the white paper is, well, what about my career as an LP? You're asking me to do a lot for an emerging manager that I may or may not know, and you're asking me to invest in a new asset class that we typically haven't. How does that impact my career? And I get that point. Kind of like it's a big payout if it works out, but it's a huge down pay if it doesn't. And I fundamentally understand where that's coming from, which is why a lot of the change needs to happen at a governance level. It needs to happen at a board level. The infrastructure behind it needs to be in place in order for these conversations to not be challenged all the time. And not in a way that's negative. We want challenge. We want debate. We want investments to be spicy. I think that's fun. But the platform needs to be there. There needs to be a space of safety. Or have we looked at this smaller fund? Sequoia might be a good opportunity, but this might be an actual better return. So for those conversations to take place, for an individual LP to feel comfortable saying, let's go into a different direction, there needs to be governance and safety behind it, which, to your point, it's not done overnight. Like we're asking for a whole restack of the entire capital stack, which is why we think these conversations are the most valuable in order for systems change is, first of all, let's have the uncomfortable discussions. And the uncomfortable discussions are not happening in these rooms. The uncomfortable discussions are happening on the LP level, kind of challenging what has been done. Why are we doing this differently? Should we even do this differently? Like, those are the uncomfortable conversations that I would love to just sit and have coffee and listen in. I'm like, what are you saying? Like, that's the conversation I really want to be in.
One of the things that we do for a lot of managers that we work with is help them think through and build out portfolio construction models during their fundraising. And one of the pieces of advice I routinely give is that your goal is to have strategic coherence. And this fund model is a way for LPs to kind of check that your strategy can be operationalized and can flow all the way down to individual checks that you're going to write to companies and own assets. And so they kind of want to see that model play out. And often I'll go back and forth with fund managers because they recognize so much can change over the course of the deployment period. They don't want to be kind of controlled by a fixed portfolio construction. And so I'm curious, as y'all did this research and you recognize that portfolio construction matters tremendously to ultimately the success of emerging managers, how do you kind of reconcile the obvious empirical evidence, but combine that with people's tendencies of behavioral finance, behavioral aspects where they don't necessarily take that risk? How do you all kind of see those playing out with emerging managers?
No, yeah, one of the things that we found empirically, but that we know just from living and being in VC in general, is that things change. The cool things about VC is that it moves super quickly and you're able to adjust and change. The downside is that returns take 10 years. So there's already a mismatch between VC in general that we're trying to adjust and kind of figure out and navigate. But in terms of portfolio construction, very similar to your point, we've spoken to a handful of LPs, and one of the things that honestly just keeps coming back is, does it make sense? Is the check that you're writing in the industry that you're writing and the timing of it make sense with what you said you're going to do? A lot of the conversations for Fund 1 managers just talks about, can you deliver what you said you were going to do? And those checks are probably a bit smaller in terms of initial investments from LPs. Once that's kind of proven out, then I feel like there's a door for larger check sizes from institutional investors or for institutional investors to come in. But yeah, to your point, step one is, can you do what you say you're going to do? With that being said, the time frame between raising a Fund 1 and a Fund 2 is usually not enough to see the returns. That window is probably 4 years, 3 years if you're just really on top of everything. But between a 4-year window, like, it's very hard for the conversations behind the actual returns to come back, but it is enough time to say, did you do what you were going to say you were going to do? Something that I always kind of just keep seeing as an investor, for example, is a conversations of follow-ons. Like, that one is always a conversation that a lot of GPs underallocate in terms of their portfolio construction. And those are one of the realities that hit. One of the realities that we see for GPs is, one of my portfolio companies is doing super well, but they're behind on a payment or two, so they need some operational capital for the next 3 months. Can we chip in and do a bridge? Like, those are the conversations, kind of to your point of life. Like, they need the check in order to continue. GPs probably didn't really factor it into their portfolio construction. So I think a lot of it just comes back to, can you justify it in a way that makes sense, and a way that shows that you're thoughtful about it? Well, I'm all for free reign and being as loose as possible with definitions in order to have a little bit more wiggle room in terms of how you invest your funding on the GP side. There's also the other face of it, which is, can this be done for an LP to reinvest in a fund too?
Yeah, I mean, I often have conversations, day one or very early on with fund managers who are thinking through their strategy. And it almost feels like they're, in some ways, going down an aisle at a grocery store and they're just kind of grabbing things off the shelves. And, they think they're following some sort of recipe or whatever. They're trying to grab these ingredients. But really what they're doing is they're mimicking or they're following somebody else's strategy or branding or voice. And they're mix matching different types of portfolio constructions or different operational strategies to support those. And what they ultimately end up with is this kind of like convoluted mess that's a little bit pre-seed, a little bit Series A, a little bit late stage, kind of a co-investment SPV process as well. And before they know it, they don't have a clear position for LPs to kind of fit into. And so in the research, I saw that y'all kind of identified those as being structural in nature, that sometimes it actually works to the GP's benefit to lean into the structural kind of constraints that they have instead of trying to maybe act like a different type of emerging or a different type of emerged manager or a different type of platform that's been around for longer, or been very much bigger than they are. Do y'all kind of speak to that in the research?
That's a hard one because it's super easy for portfolio construction to be swayed by what we see a lot of it, honestly, just through social media. Is Sequoia's doubling down in AI? Maybe I should do the same. Someone else has this huge branding platform. I was able to raise 100 million just on LinkedIn and X. Maybe I should do the same. But kind of back to your question is, does this speak to myself as a GP or my team as a GP? And is this something that we can continue to do for the next fund? So sustainability is something that I always want to keep coming back to, and authenticity. Because at the end of the day, a lot of institutional investors, I won't say all of them, but I don't want to oversell myself on this one. They're investing in people. They're investing in individual GP teams. So if that just doesn't speak to them, it's pretty obvious. It just comes up in diligence. It comes up in conversation. We're like, this isn't really you.
I think you're spot on there, because if you have a growth investment background and you were trained in that, and that's the type of fund you want to raise and invest, people see that story. But if you are, in many cases, I engage with emerging managers who are first-time entrepreneurs, first-time investment managers managing somebody else's capital as a fiduciary. And then maybe this is their first time investing in this particular asset class venture. And so there's deal mechanics and process and all these things that are new to them as well. So they end up having a lot of newness. And so oftentimes it's more about helping them focus versus there's just so many choices as a manager and working with so many different types of LPs. I find the hardest thing for them ultimately to do is like pick one path and go relentlessly forward at it. And instead there's so many distractions.
One of the findings that came out of our report was that emerging managers who maintain check discipline, build breadth in their portfolios, and lean into relationship-driven sourcing succeed because their strategy and constraints sort of reinforce each other, right? So they sort of have to be a little bit more tactical in how they build those portfolios and how they're building those relationships. So the performance there is not necessarily abstract. It is definitely empirical, and it was something that we were able to find, and it is accessible for some of these LPs who are not currently investing.
They're just scrappy. They're just better at doing a lot more with less. But empirically, that just sounds a lot fancier. At the end of the day, yeah, emerging managers just do like miracles with the check sizes that they have. And I genuinely say miracles because there is a trade-off for an emerging manager for every check that they write, whether it's an initial large investment, whether it's a smaller investment, whether it's a bridge or a follow-on. Like there's a huge risk attached to it. Like there's no room for error, which is the fancy way of saying they're amazingly scrappy.
Yeah. Well, I think of specifically for Fund 1, right? Let's say hypothetically you raise a $20 million pre-seed Fund 1 with some high net worth investors, people in Silicon Valley. They're very, very close to venture. They understand it very much. And when they pick you as a manager, my mind is, at least as I understand it, many LPs, they want access to deal flow. They want decision-making on who they think will be ultimately a successful winner. They want information and intelligence from your being out in the market as a manager to kind of report up to them for many different reasons. And that's slightly different than if you're a later stage investor. There, it seems like it's much more defined what information is available, and like you can make decisions that it's much more structured and much more analytical than I think the squishy gray area of pre-seed and seed. And so I often will see managers in their first fund playing in that early pre-seed space as a way of identifying, I got access, I know where great companies come from, and I got judgment. I know who can probably build these things. And like that's your proof of concept in Fund 1. And then as you go to Fund 2, you might be changing it a little bit, but you're not dramatically changing your strategy. You might be increasing your check size a little bit as now you've had opportunity to kind of refine your picking ability and refine some of your processes, that now you can step up to lead rounds or to make bigger investments that carry more risk for the risk adjusted return if you're putting more dollars to work earlier. That's usually what I see is like Fund 1 is that playground, so to speak, for people to really work through the issues. And then fund two is where they start doubling down.
Yeah, I think another way to frame exactly that is fund one is a way to test a portion of your thesis with the limited capital that you may have. So you may not be able to play out your whole thesis, which is one of the things that I love is that as GPs, we're building firms, not just a fund. So kind of being able to define what the strategy looks like for the firm and how fund one plays into it, how fund two plays into it makes a little bit of sense in terms of how does that story continue. Kind of like we're not changing the strategy, we're building on what we did previously. So investing in a firm is probably the best way I like to describe it to GPs who are probably saying, I really want to jump into growth, but I don't have a $500 million fund. Like, well, maybe you can start with a handful of Series B. That's building the muscle. You proved your point.
Yeah, absolutely. I mean, SPVs right now are kind of the proof point for growth investors. There's, maybe 10 companies that are really actively trading that people are out marketing and raising for. So it's a great way to prove to LPs that you can get access to the deals, that you can run a process, that you can get into these and kind of compete at this level before you raise a growth fund. And then early, running syndicates are also, I mean, they're smaller SPVs, so it's very much more operationally intensive, but running a proof of concept or some sort of way to show LPs that here's who I will pick, here's the companies I will put into a portfolio. I think people immediately assume I say I'm going to raise a $50 million fund. I go out to the market because I'm smart and talented and accomplished, and people would just give me money. And they're very quickly come to the conclusion that it's a lot more complicated than that to raise large dollars from people. There's more trust, more relationship, more explanation, more authenticity, as you said, that goes into it. All right. So my next question, I'd love to kind of think about the platform of Colibrí. So what is next for the platform as you think about either research or, engagement?
Yeah, so we are actively refining our research agenda for 2026. We will be having at least 2 more white papers coming out. The second one, Itzel can probably tell you about it a little bit later, should be coming out. It's on risk return efficiencies, should be coming out at the beginning of Q3. And then we're hoping to be able to find the right data for a paper to come out maybe in Q4 that really tracks the capital flows from LP to GP and then from GP to founder. So those are the actual research reports that are going to be coming out. We're also really, really knee deep in constructing our primers and level setting information through the lens of the emerging manager to inform policy. So we've been working really hard on creating the first primer, which will hopefully come out in the next month and a half or so. And that really just addresses why capital flows or why the VC emerging manager deserves a seat at the table as we're talking about tech and AI governance. I think most immediately we will be at the Milken conference next month. We are really just trying to evangelize folks with the research that we're putting out and just share more information so that we can build an ecosystem where more emerging managers are able to unlock more access to capital.
Because I think anything that helps LPs get comfortable with venture, which is a new asset class. I mean, compared to traditional private equity or real estate or hedge funds with public equities, all that stuff is a lot more known to LPs and to the family offices or the investment teams or, the committees that help support that. And I agree that there's just not a lot of policy conversations for this audience. And so we need to have it, and then we need to break through and get it in front of them. And it does seem like there are some great strategic partners to help do that. And so, yeah, Milken sounds wonderful. Hopefully, maybe we can figure out a way to get our conversation in front of a number of these LPs and their investment committees, and ultimately work with them to try to figure out some standards for emerging manager diligence, where we can just publish it and now everybody understands generally what's expected. I think that would be really helpful because there are very few standards out there right now. And I think a group like yours could really help us kind of build the coalition to build some standards that we all generally accept.
Yeah, for sure. And yes, we are sort of identifying the problems and identifying solutions, but on our strategies advisory side, we're also implementing solutions. And so We are actively working with LPs who are either interested in building an emerging manager program or have an emerging manager program that needs to be maybe reassessed or diagnosed. And then we are also open to working with GPs, right? So we really need to be looking at both sides of the coin there. And so how do we help GPs through evaluating their portfolio construction, just like you guys are, and then really thinking about their back office too, right? Because what we're finding is that a lot of the folks that are within our community, one of the main reasons why they're unable to unlock institutional capital is because their back office is not what it's supposed to be. Part of that is right because they're mostly raising from high net worth individuals and family offices who don't necessarily have the same governance and diligence processes. And so we really want to make sure that we are helping them set up that foundation so that they can unlock that capital whenever it is that they are ready to.
Mariela, there's some key ideas about how to build an emerging manager program that those, institutional allocators that are building these programs, they should consider. And I know y'all did some research into it. What are some of the insights that y'all found about how to design a program where emerging managers will actually succeed?
Yeah, so I will call out sort of the 5 headlines that we have for our 5 design principles, but obviously folks can go back and read it more thoroughly in the paper. But the first one is that emerging managers should be integrated, not isolated from the investment portfolio. They should be selected based on performance, not based on compliance. There should be a configuration focused evaluation of the emerging managers. There should be a dual focus on selection and incubation, much the way that we think about a funder and founder relationship where there is mentorship and guidance along the way. We believe that the same thing should be true for the LP and GP relationship. And then the final thing that we'll call out is that this should be the decision to invest in an emerging manager should be based on evidence-based risk assessments. And so again, they can read more about that in our paper, but also I will call out that we have a free tool that LPs can use on our website, completely confidential, that will help them self-evaluate their own emerging manager programs if they do have one, and then give some specific feedback based on their responses.
In y'all's experience, have you found that there are some consistent, either biases may not be the right word, but things that people are like easily overlooking or not considering as they're designing these programs that you see as like a recurring issue or theme that pops up when you talk to these types of program managers?
I would say that I wouldn't say that it's now like it's still recurring. I would say that back in 2020 there were a lot of political mandates that were made to establish emerging manager funds. And a lot of those funds were given out sort of without the proper evaluation, I will say. And so I think that really set us up for a failure mode that we were not really prepared for, right? So now because some of those investments back in 2020, maybe 2021, were not properly evaluated, they are not making the same returns as someone who would have been an investment based on the same evaluation criteria or the same diligence criteria. So that is now affecting us, and it's sort of giving us an issue when it comes to fundraising, right? So because a lot of those programs are now getting rolled back because there was no proper diligence and now there are no proper returns, we need to make sure that we don't confine emerging manager programs to political mandate. And so that would be sort of the one huge call out that I give. We think that it's amazing that a lot of corporates and large foundations and large allocators said we want to contribute to the community by standing up this emerging manager program. But it was done very reactively and wasn't necessarily thought all the way through. So I would encourage LPs who do want to stand up more of these emerging manager programs to consider these 5 design principles that we just talked about as they're building those programs out.
That resonates a lot with me, especially to your point of, performance over compliance. VC is incredibly hard and the competition is stiff. I mean, I jokingly say this to folks, but it's not uncommon to meet a venture capitalist who is a Navy SEAL, Harvard grad, astronaut, doctor. I mean, these people are truly exceptional in some cases. And so if you want to compete in this world, performance is how we judge it. and it's ultimately the final arbiter for all of this. And there are other opportunity costs for LPs to allocate their dollars to. They are always looking for that highest performing asset classes and investments. And, there's some diversification in there for risk management. But yeah, I mean, I think it's a good reminder that ultimately what drives venture is returns, and that we're all part of this ecosystem at different points in it. But if we misunderstand what we're all probably trying to do is ultimately drive returns, then I can understand how you get these like perverse incentives or unintended consequences that arise from decision making that wasn't based on, kind of repeatable evaluation criteria. And I guess my follow-up question then is, in terms of some of these evaluation criteria, do you have any guidance for program managers or people making these decisions of where they can start to build out their own evaluation criteria, or how to go about thinking about your evaluation criteria?
I think a good way to start for specifically the LPs is consider venture capital as an investment asset class. If this is a new space for you, read our report, check it out, learn a little bit more about it, get involved in the ecosystem. Venture capital might be a good place for you to start. Learning more about what the work that is out there. Second of all, consider emerging managers as part of that sleeve of investment and what that looks like. Once we get to the criteria mode, I'd highly encourage everyone to take a look at what enterprise risk might be looking like for different GPs as opposed to perceived risk. So enterprise risk is probably my big takeaway for evaluating GPs.
Okay, so talk to me a little bit more about enterprise risk. So how do you all think about enterprise risk, and what are the important considerations for GPs and LPs there?
Yeah, enterprise risk at a high level just takes out perceived notions around what risk is, such as AUM, and just provides a very solid and direct assessment of a GP, particularly their back office, and what that ability to scale looks like, because the enterprise risk behind it may not be tied to the number of people there, may not be tied to the AUM, but it may be tied to procedures and processes, such as legal. What do you have in the back office for K1s? How does your accounting team look like? How do all of these processes come together? At a high level, I think we're talking about back office maturity.
I think AUM often is used as a way of stack ranking managers. And I agree, it's not necessarily determinative of what's going on. Personally, if I was an LP out there allocating, one of the big considerations for my enterprise risk assessment would be, what indicators do the GPs give me that they care about this? Because if GPs care about it, then it will get done, and you will meet many different types of managers. Some of them are more process driven than others. And I find that while there's lots of ways to build a firm, there are many different types of LPs to build a firm for. If you're building for institutions, if you're building for the large allocators, they do like process, and they do want to be able to see it, and they want to be able to understand how you came to your decisions, and they want to try to underwrite the repeatability of that. And so I think if your goal is institutional capital, then you as a GP are probably the most important part to figuring out that enterprise risk profile for your firm.
Yeah, and I think for GP, something important on that end is processes are not there for the sake of being there. The rationale behind processes and infrastructure comes back to scalability. That doesn't mean that we take away the flexibility behind it. It just means that it's intentionally baked. And I say that as a founder who does not like processes. I am not a big fan of them on a personal level, but I get the scalability part of it. And as long as intention is built behind it, I think that's what's probably most important.
Yeah, and I think that one thing that GPs maybe not considering as much is that this isn't something that you're building one time, right? This is something that needs to be it's a living, breathing thing that you need to continuously improve on. And so yeah, I would just encourage GPs to think about their back office as something that is a living and breathing thing that is sort of makes or breaks a deal.
Itzel, following up on the research report and all the great work y'all are doing, as you speak to LPs, is there kind of a final takeaway or something you would really hope that limited partners and institutional allocators would take away from their research?
Yeah, I think the main takeaway, honestly, is to have a self-evaluating question as, is emerging manager program built to capture alpha? And I think that answer will take you down a lot of different rabbit holes, but I think it's a good place to start.
Great. And Mariela, for you, for GPs, I would love to hear what you think are some of the key takeaways that GPs should understand from this research about how to position themselves and how to engage with limited partners.
Encourage GPs to focus on two particular things. Number one, as we've been talking about off and on, is enterprise risk, right? So enterprise risk is a function of four fundamentals. So document adequacy, financial health, operational efficiency, and team dynamics. So definitely make sure that they're focusing on those four things as it relates to enterprise risk. And then the second thing is to find help thinking about portfolio construction early. That is something that is also going to be fundamental, and it's a key decision point for any LP. So I would encourage a GP to make sure that they are finding help for their portfolio construction early on.
Well, great. Well, thank you all very much for this detailed conversation today. If folks wanted to reach out and get in contact with y'all, what's the best way to do that?
Yeah, so we can both be found on LinkedIn. Mine is Dr. Mariela Salas, or just Dr. Mariela Salas. And then they can follow us on Substack. Both Colibrí Strategies and Colibrí Institute is on Substack and on LinkedIn. And then if they have any direct questions for us, we can be emailed at hello@colibri, that's COLIBRI.institute.
Awesome. Well, I've really enjoyed the conversation today, and it's been wonderful getting to know y'all. And I look forward to continuing to collaborate, and hopefully we all make a little bit of a positive dent in the emerging manager ecosystem.
And that's what we're here for. Thank you so much, Dave.
Thank you
Thanks.
so much, Dave. It has been so much fun.